Think about this. All the government legislation, all the business innovation, all the scientific advances and medical advances, commodity prices, currency exchange rates, geopolitical situations like Ukraine, all these, if a ship gets stuck in the Suez Canal, that shows up in the stock market. All these various things are happening. It's a wildly complicated, hugely complex world.
At what is the worst stock market opening for 50 years. And I have with me today Alex Green, who is the investment director of the Oxford Club. I've known him for many years. He's actually been doing this a lot longer than I have. We want to talk about market conditions, but then specifically some recommendations that he's made that one in particular has gone up over 300%. So even though general conditions don't look so good, there are investments that you can make that can weather this kind of storm. So welcome, Alex. I haven't seen you for a long time. We were just chatting off screen about not seeing each other since before the pandemic. So
right,
good to have you, and thanks.
Good to be here. Good to be here. And unfortunately, there's a lot of people I haven't seen in a couple of years because of that nasty pandemic. But glad it's mostly behind us now.
Yeah, so let's just jump right in and talk about market conditions post-pandemic, and you know, there's a lot of things going on. There's the Fed trying to battle inflation, and there's lots of questions about technology stocks going down and then dragging the rest of the market with it. Let's just start with your general overview of what's happening in the market right now.
Okay. Well, as you said a minute ago, it's been the worst start of a year for the stock market in a half a century. And in some ways, it's not hard to understand why, because we have the highest inflation in 40 years. We have a global supply chain that's completely snarled still. We've got a Federal Reserve that's dead set on taking interest rates much higher because they've been so far behind the curve, they might as well be on another road. We have a conflict in Ukraine that no one knows how it's going to wind down. You know, that's not likely that Putin's going to leave with his tail between his legs, and so the question is, what does he get for his misadventure? And that's and then will the misadventure become even a bigger misadventure and draw in other players? So it's an uncertain time, and markets don't like uncertainty. They like to at least feel like they can see their way through the fog. You know, markets always looking out 6 to 9 months. It's a leading indicator. And so the markets reflected the fact that things have changed dramatically. We've got higher oil prices, higher food prices. That really hits people at the lower income levels. And it's put into question whether we might ultimately be going into recession. And if we go into recession, we're going to see lower earnings. And if we're going to see lower earnings, then multiples are going to contract further. So there's a lot of fear and anxiety out there right now.
Yeah, I think when I first met you, it was the late 90s, and we went through the tech wreck. First was a boom and then a bust. And then we weathered 2008, 2009, 2010. Can you put this into perspective from your own investments and like the way that you're looking at the market to what we experienced in those times?
Well, the way I put it is, you can look back at every dramatic market sell-off for the last 200 years, and it's been a buying opportunity. All the great investors of the past and the present, Warren Buffett, Peter Lynch, John Templeton, others like them, have always recognized that bear markets, as scary and downright frightening as they can be, are opportunities to buy solid businesses at much better prices. And you know, it takes some nerve to step up and do that, and you shouldn't buy indiscriminately. There are companies that may not make it out of a tough period like this, and you want to avoid those. The old saying is you want to hunt with a rifle instead of a shotgun. But I do think that if you look back from a couple of years from now, what are you going to wish you were doing? Not waiting to pick the bottom, not just buying indiscriminately, but going out and buying great companies that are selling at bargain prices. And so that's what I'm really suggesting that my readers do.
Yeah, and so how do you figure out, all right, what are your metrics for figuring out what's a good company to buy when everything's getting taken to the woodshed?
Yeah. Well, I would question your premise there about whether everything's getting taken to the woodshed. Certainly the S&P 500 is down sharply, Nasdaq's down over 30%, the Russell 2000 small cap index is down over 30%, but there are certain sectors. Oil and gas are doing well, natural resources, dividend paying stocks, value plays are actually holding up pretty well. But you're right, you need to apply a set of metrics. And so what I've done is I had a team of researchers go back and scrutinize the best performing stocks in the stock market for the last 100 years. And even though these were different companies in different industries run by completely different sets of people, it turned out that they had a number of things in common before they made their parabolic moves up. And so what I've done is I've distilled those down into a few metrics, and I'll give you a few examples. The best performing stocks tend to have sales growth of at least 10%. Okay. Now, most companies like the S&P 500 are growing sales at about 3%. So this is 3 times as strong as average sales. They tend to have earnings of at least 20% growth over the previous year. And in the most recent quarter, it's been growing at an even stronger rate at 25% or better. So let me just stop there, Edison, and say, if you're only looking for companies with sales growth of 10%, 3 years of 20% or better earnings growth, and the latest quarter's up at least at 25%, you've already eliminated 95% of the stocks in the market. So the idea is to just keep narrowing it down. So beyond that, I'm looking for companies that are earning a return on equity of 17% or better. Return on equity is simply earnings per share divided by book value per share. It's a great measure of management's efficiency with the use of the firm's capital. And even though Buffett follows a value methodology, and this is a growth or momentum methodology, he says his number one criterion for evaluating companies is high return on equity. I'm looking for companies that are innovators, that are introducing new products and services. I mean, everybody knows that Apple's been one of the best performing stocks over the last few decades. And when you think about it, it's one of the greatest innovators. They had the iMac, and then the iPad, and then the iTunes music store, and the iPod and the iPhone, and all these new iterations of iMacs and iPads and so on. And they just kept innovating, and that strong innovation drove the double-digit sales growth that led to sometimes triple-digit earnings growth, and probably 5-digit growth in the earnings or the price of the shares themselves. So I'm looking for innovation. I'm looking for companies that have great management, because you never want to forget the fact that companies are essentially just teams of people. And just like a sports franchise needs a Bear Bryant or a Vince Lombardi or a Phil Jackson to realize its potential, you need a Sam Walton or a Steve Jobs or a Larry Ellison to bring out the best in a company. I'm looking for strong institutional support. I'm looking at share buybacks. Share buybacks are big because if a company's buying back its own shares, number one, management's got to be very optimistic about the future prospects for the business, because they're essentially betting their careers. They're going to spend tens of millions or hundreds of millions of dollars buying shares back. They better not be cheaper at the end of the buying spree than they were at the beginning. And also, just mathematically, if you reduce the number of shares outstanding, if you divide growing earnings by a reduced share count, you get even stronger growth in earnings per share, which is what ultimately drives share prices higher. So these are just some of the metrics that I'm looking at. And so if you run all the stocks in the market through these screens, and they have to have sales and earnings and return on equity and innovation and high quality management and share buybacks and institutional support and certain technical factors that I look for, you're only left with a tiny subset in the market. And you end up with the companies I talked about a minute ago, mostly energy companies, other natural resource companies, lithium companies, for instance, are doing really well. Some pharmaceutical companies are doing well. A lot of high dividend paying stocks are doing well. And so in a momentum strategy, in a down market, you're finding that while 4 out of 5 stocks do follow the downtrend, you're able to zero in on the 1 out of 5 that's going against the trend and going up when the broad market is down.
So you're not looking at them specifically for sectors. You're just looking at for the metrics of or performance of the company itself.
Yes, I'm not taking a sector approach, but when you use that individualized approach, for instance, like on my screen, of the top 50 companies, probably 40 of them are in oil and gas or natural resources now, because that's just what's on a tear. Because look at the price of oil and gas. They're both way up. Most of those companies have relatively fixed costs, so higher market price means that it's all flowing to the bottom line. They're much more profitable. Those companies, incidentally, you probably know this, Addison, but some of these great oil and gas companies with double-digit earnings growth are selling for 8, 9, 10 times earnings, whereas even after the sell-off, the S&P 500 is selling at about 17 times earnings. So they're growing faster and they're cheaper, and they're in the sectors of the market that are going up when the indexes are going down.
I want to ask you a question that's sort of unrelated to the theme we're on right now, but I was just approached by Wiley. We share a publisher at Wiley, and they're republishing your Gone Fishing. They're republishing the book, but you have a portfolio that goes with that. So if you could just sort of explain how the way that you look at companies, the metrics, and how they weather the market. Explain what Gone Fishing is, and what does that mean in terms of people trying to manage their money over a long period of time.
Okay. The book is the Gone Fishin Portfolio. It originally came out in 2008. Great time to have an investment book come out right before the financial crisis.
Yeah, exactly.
But it was well received. It hit the New York Times bestseller list, and then Wiley wanted to reprint it, and longtime subscriber Bill O'Reilly kindly offered to write the foreword to the book, so he's in there too. And so what I was talking about a minute ago was a trading strategy, buying the best performing stocks in a down market. The Gone Fishin Portfolio is a different approach. It's a long-term asset allocation approach to investing. And so the basic premise of the book is this. You're never going to know exactly what the economy is going to do. You're never going to know the best times to get in the market and get out. So why don't you just asset allocate your portfolio? And by that, I mean divide your risk among different asset classes like foreign and domestic stocks, large caps and small cap stocks, growth and value stocks, high yield bonds, high grade bonds, inflation adjusted treasuries, real estate investment trusts, and gold shares. Those are the 10 different asset classes. So all you do is using an indexed approach, and I said you can use Vanguard mutual funds or ETFs. You simply divide your portfolio up, not equally, but I explain in the book, you weight the different asset classes, and all you do is take 20 minutes once a year to rebalance the portfolio, and then leave it alone to the next year and spend 20 minutes to rebalance it again. And so the idea is you've gone fishing. You don't have to watch the market. You don't have to trade your portfolio. You've got your. I don't say it's not set it and forget it. It's set it and don't forget it, because once a year you have to rebalance it. So, so the amazing thing is I came out with that strategy 20 years ago, right after I joined the Oxford Club. It's been in our communique every, and not only has it beaten the S&P 500, even though it's 30% in bonds, but as of the end of last year, it was beating Berkshire Hathaway over the period. So now. I don't know if it's going to continue to do that, because bonds yield so little now that it's hard to imagine going forward you're going to get much firepower out of the bond, the fixed income portion of your portfolio. But essentially the idea behind the Gone Fishin Portfolio is you can devote a lot of time to your investing if you think of it as a hobby, which a lot of my readers do. They just enjoy the challenge of being in the market, making money, beating the indexes, and so on. And so they're sort of short-term oriented and trading action oriented. This is for people who just want to set it and spend 20 minutes a year on their portfolio and still get good enough results that they could manage their retirement accounts or actually the bulk of their net worth this way, and then have fun with the rest of it, doing a little bit of trading on the side.
Okay, so let's just be clear then. There's a difference between that kind of long-term investing and the momentum trading that you're also talking about.
Yes.
And I try to make this point as clear as possible, that there is investing and there is speculation, and they are two separate things. There are a lot of people, your readers, my readers, people that we have talked to at conferences and when we go around and do our media stuff, who think that investing and speculating are the same thing, but they're really not. It's like a different mentality.
It
And
is.
and you can do both, and you yourself do both.
Yes.
But you have to be aware of what you are doing. Are you speculating or are you investing? So gone fishing is an example of investing over the long term.
It's the most conservative thing we do. And actually, you bring up an excellent point, Addison. It can't be said often enough, especially because we have a lot of people who've just become investors in the last couple of years, who've come in and are now part of the Agora family. And I tell people, let's just start by defining our terms. Investment is long term, and it means you don't obsess over the short term ups and downs in the markets, or even whether we're in a bull market or bear market, except to the extent that you want to add money while shares are cheap, whether you're doing it through ETFs or mutual funds or whatever. Trading is a short-term oriented activity. You're not ignoring the short-term turns in the market. You're trying to take advantage of them. And speculation, I always say, is also short-term, but you're taking a higher level of risk. And so I put things like penny stocks and options and things that can potentially go to zero. And I call those no tiers investments. If you want to take the chance of earning 300, 400, 500% returns, as we've often done in these various trading services, that's great. But also understand that you are speculating, and if you're going to gamble, which is something of what speculation is, you're going to have things that just don't work out. Whereas with the Gone Fishin Portfolio, yeah, we can have a down year, but you never have to apologize for the way your portfolio worked out over the long term, because it's a long-term conservative investment strategy. And there's more conservative trading strategies, and there's more conservative ways to speculate as well, which we can get into all that. But I think everybody who's acting on our advice needs to understand this is an investment, this is a trading strategy, and this is speculation. And my own conviction is you should do them in separate portfolios, separate accounts. You shouldn't have your trading ideas in your long-term portfolio, and you shouldn't be trading your long-term ideas, and you shouldn't have a trade that goes wrong and go, oh, well, it's just a long-term investment, because then all you're doing is rationalizing. You've left your discipline behind, you're making excuses, and it's not likely to work out. So
yeah, I feel like we can't say that enough. Like exactly what you're talking about. We cannot say that investing is for investing, trading is for trading, and speculating is for speculating. I don't think we can say that enough. We can say it again and again and again. And a lot of people just don't listen.
Yeah, it's funny, Addison. I feel like I should say it at every conference because people are so confused. Like, for instance, when you rebalance your portfolio, you're selling what's appreciated the most so that you can add to what's lagged the most. And people go like, oh, but I thought you're supposed to cut your losses and let your winners run. I said, yeah, that's a trading strategy.
Right.
And so if there are different activities, and it's like the old, I run to people all the time, they go like, well, isn't the stock market just a big casino? And I go, well, it can be. If you want to buy a stock at 10 a.m. and sell it at 10:30, you're treating it like a casino. But you can be a casino owner and collect all those chips if you want to take a longer term approach. In fact, casino stocks have been one of the best performing sectors of the market over the decades. And I'll never forget the first time I took my son to Las Vegas, and he walked into the casino. Of course, they told him to keep moving because he was underage, but he's looking at all the glamour, the lights, the people laughing, drinking, shouting, excitement and whatever. And he goes, Dad, are most of these people are they making money? And I said, son, I want you to look over that window in the corner. And he goes, the one that says cashier? I said, yeah. I said, how long is the line over there? He goes, Dad, there isn't a line. I go, that tells you all you need to know right there. Yeah, exactly. And so you have to know.
We're having fun.
Yeah. So you can speculate and have fun, or you can have some excitement and earn good returns, or you can take a more conservative long-term approach. And the choice, they're not mutually exclusive. Everybody can be doing some of each. But I don't think if you're retired, you shouldn't be speculating a lot. If you're young, you shouldn't be in boring CDs and muni bonds. You need to do something that's sort of age appropriate, and everybody has to decide for themselves how much investment, how much trading, and how much speculation. And of course, nobody has to do anything more than invest. Everything else is if you want to do it.
So during market downturns like what we're experiencing now, it's more volatility than it is a downturn. I mean, certain sectors are getting hammered more than others. But how do you, as a long-term investor, how do you think about that? Like, what is it that you want to stick to your guns,
right,
the metrics that you said, but like psychologically, how do you deal with that?
Right.
Because a lot of people just want to be like, oh man, that didn't work. And
yeah,
they start start panicking or
Right.
questioning their own hypothesis.
Yeah, right. Well, see, in addition to the fear and anxiety in down market, there's a lot of regret, and that regret, you're like, I never should have done this. I shouldn't have gotten in the stock market. I've got too much money in stocks, and then that thought leads to making a really bad decision, which is I'm just going to get out of the market for now, and I'll wait and get back in later when things look better, as if they're going to look better at the bottom of the market than they do now. Now, you could get out of the market, and it could certainly go lower, but you also, at some point, stock to move higher very quickly. And if you miss the best days in the market, you're going to diminish your returns considerably. So I start by telling people, you know what, you can look back at every bear market of your lifetime, and the best, well, I'll start with the worst. The worst investors panicked and sold. The mediocre investors, they felt terrible, but they didn't do anything. They sat on their hands, and maybe they at least reinvested their dividends while stocks were down. But what did the best investors do? They took an opportunity-oriented mindset, and they said, I'm going to pick among the rubble here and see if because the whole market is down, the things have been thrown out, the baby with the bathwater, that really are worth buying at these levels. And again, you need to be discriminating. That's why we started off talking about, for instance, with the momentum strategy that I use, I'm looking at sales and earnings and return on equity and share buybacks and other things, that I'm doing some due diligence and trying to select the best of the best. And even then, you're going to have ideas that simply don't work out. That's, I always tell investors, Ted Williams was the greatest hitter of all time. And 60% of the time, he didn't get a hit. And you don't have to have it's not like you have to stack one winning trade on top of another to be a great investor. You could actually have more losing trades in a year than winning trades. But if you're cutting your losses and you're letting your profits run, it could still be a good year, or at least a year that maybe you're down, but not down as much as the market, which is still a win from any reasonable standpoint.
Well, if you want to, you could talk about each one of your services and like how what do you call a win in each one? So you can start with with the Oxford Club and just move on from there.
Yeah. Okay. Well, we have wins on the stocks, and then obviously when the options work, they're even bigger wins. But we never have a stock go to zero because we use trailing stops and options. If sometimes you have an option that just doesn't pan out, it's going to be a write-off. So what I do in the momentum alert, I've basically sort of laid it down, the metrics that I use. Another strategy that I use as a trading strategy is the insider alert. And with this strategy, we're basically looking at the people who run the company, the officers who are the president, chairman, CEO, chief legal counsel, and so on, and the directors who are the board members appointed by the officers to oversee the company. And these people have access to all kinds of material, non-public information about the future prospects of the business. That's the advantage they have sitting in the seats that they do. They can see the daily sales receipts. They can see new products and services in development. They know the status of litigation against the company, whether they've gained or lost any key customers or employees, whether anyone's talking about taking the company private, whether they're receiving any unsolicited takeover bids. This is all things that these people are privy to. So obviously, they have an unfair advantage when they go in the market to trade their own company stock. And that's why the US government requires them to file a Form 4 anytime they trade their own company shares, stating how many shares they bought, on what date, at what price. And this at least levels the playing field, and that the rest of us get to at least see that the chairman or the CEO was buying 1 million shares or $10 million worth of the stock or what have you. And we still don't know what they know, but at least we know they're doing it. And so that's the basic strategy, but then you've got to do more due diligence. I'm looking at, for instance, the size of the transactions, because bigger trades tend to denote larger conviction that the stock is undervalued. I'm looking at the trading history of the insider. Have they bought the stock in the past? And if they did they buy it when it was low and sell it when it was high? And oftentimes officers or directors at one company will sit on the board at another company. So then I go out to those companies and I go, do they buy that stock? Do they buy it low and sell it high? And if they do, I tend to rate their transactions higher than someone who doesn't have that kind of track record. I'm looking at the number of insiders buying. Cluster buying is good if it's not just one guy being the lone ranger, but a number of people buying at the same time. This is a little bit counterintuitive, but when you see insiders buying at the high end of the range, it's a very positive signal. Usually there's something happens, it's negative. There's an earnings miss or a product recall or a class action suit or something, and the stock tanks. and the insiders will jump on it and start buying it. And what they're essentially saying is, yes, we've got problems, but the problems are temporary, they're solvable, and the stock is an overreaction in the market, and so they buy the stock. But the people who are buying, the insiders who are buying at the top of the range, and this is what tricks people up. They go like, why would the insiders buy at the high end of the range when they could have bought at the lower end of the range? And I've learned over the years that when that happens, what essentially the insiders are saying is, yes, the market recognizes that the outlook of the company is good. If it wasn't good, it wouldn't be trading at the high end of its range. But the market still doesn't understand just how good our prospects are. And so they're willing to buy at the high end of the range. And then oftentimes, of course, the stock is much, much higher 6 or 12 months down the road. So anyway, this is just another strategy. If you ride the coattails.
In the reverse too, though. I mean, sometimes we get massive selling from these.
Yeah. Well, that's a good point, Addison. And here's what I tell people. There are reasons that an insider would sell that might have nothing to do with the outlook for the business.
They gotta pay for
diversifying their portfolio, or maybe they're getting divorced and have to sell half their share, or they're buying a big house, or putting their kids through private school. So, even wealthy officers and directors have an overhead, and so sometimes they're selling shares, and it's not related to the business. Although often, like with Enron, those insiders sold billions of dollars worth of stock as it went down and down. They could not get out fast enough. Now, why? Because they realized the whole charade was over. So I'm not saying that insider selling is not sometimes a very good signal, but when you turn it around and you say, why would an insider buy millions of dollars worth of his own company's stock with his own money at the current market price? There's only one reason, and that is, even though they're fallible human beings, given all the information they have about the company, its employees, its suppliers, its customers, its competitors, and including all sorts of material non-public information, they've judged that the stock is selling for a lot less than what it's worth. And then they buy it, and they have to file within 48 hours a Form 4, and that alerts the rest of us. And I'm watching these Form 4 filings every day because they're full of valuable information. And Addison, here's an interesting thing you talk about in this nasty market. What do you do? Under ordinary circumstances, let's just say we're in a typical bull market. The insiders pounce on the stock, they buy millions of dollars worth, the news hits the wire, and the stock immediately spikes higher. Why? Because hedge funds and other smart investors are looking at what they're doing. But in a down market, this is the crazy thing, the insiders, the stock will be down, the insiders will pounce on it, and 3 days later, the stock will be even lower, and 2 weeks later, it'll be lower still. And there's actually a ton of stocks that you can buy out there right now that are selling for less than the insiders bought them. And here's what I tell people. I wrote a column this morning, and I told my readers, I said, you know what? This insider I think he bought something like $25 million worth of stock this week. And I said, and guess what? This guy knows inflation is the highest it's been in 40 years. He knows the Fed's taking interest rates higher. He knows about the global supply chain. He knows about the war in Ukraine. He knows all those things, and he still bought $25 million worth. So when you say like, yeah, but you say the market's cheap, but what about inflation? What about interest rates? That's all factored in. So I just think that there are strategies, and riding the coattails of knowledgeable insiders is one that you can use even in a down market. And remember, you're going to look back 2 years from now. This could be a 2-year bear market. Maybe things have not bottomed out yet, but in 2008, 2009, you didn't have to buy in October or December or February of 2009 to get a good deal. You could have bought any of those times, and looking back a few years, you go, wow, that was a great price. I should have been loading up. That's what people, I wish I'd been loading up. But you know what? They're too scared at the time.
Yeah.
Because
I feel like people are too scared right now to even make decisions, buy or sell.
Yeah.
And it's like one of those inflection points, especially as we move into summer. There's the old adage, sell in May and go away.
Right. Don't come back to Labor Day.
Buy as much as it used to, but people are starting to wonder, like, oh, should I hold on to some of the stocks that I have through September?
Well, remember, maybe some stocks you should be selling. Like this, to get an example, we know that oil and gas prices are much higher. If your company's profitability is based on low oil and gas prices, the stock is probably down. And you know what? Oil and gas prices are not coming down anytime soon. You probably should sell that stock. Maybe you should be selling it and buying an oil and gas company. So there's not a generic buy everything or sell everything. That's market timing. If you're totally in the market or totally out, that's market timing. And I'm not even talking about sector rotation, like rotating out of technology and into oil and gas. There are some technology companies, and especially medical technology, because healthcare demand is relatively inelastic. If you need a medical procedure, you're going to go get a medical procedure. And so companies in the healthcare industry and in medical technology are probably going to see their sales and earnings hold up just fine. But other companies are not. So you should be selling the underperformers that are likely to continue to underperform and putting your money to work in stocks that are going to perform better going forward.
Yeah, and do you think, is that one of the approaches that you take in Momentum Alert?
That's momentum, but I also can tell you that the insiders aren't piling into stocks where they go, oh, we're going to get slaughtered by high energy prices. Then you don't go out and buy your own shares. You don't buy them. So just the fact that they are buying is telling you this: the people who know the most, the smartest people on the planet about that company, are buying millions of dollars worth. That's valuable information.
Yeah. All right. So just as a way of kind of concluding our conversation today, what are you looking forward to? It's beginning of June, the next 3 months. Because I feel like it's sort of a pivotal period. I've talked to a lot of people who think that we're going to crash right now because of inflation and Fed shenanigans and whatever government intervention we have, but also just over priced stocks. They're sort of doomed to fail at the moment. But at the same time, there's a lot of other people that are thinking, oh, stocks are getting cheaper. I can buy them, and I'll buy the stocks that I want to buy, which puts a floor in some sense for a lot of stocks. And then also you have things like you've mentioned many times, the energy sector is going to take off during a inflationary period. So what do you see, like, say, between now and September, just market wise?
Yeah, well, it's interesting you asked that question, Addison, because just this morning, Citicorp said, we've reached a point of maximum bearishness. We're somewhere near the bottom.
Yeah.
And then this afternoon, Jamie Dimon at JP Morgan says, I'm telling everyone to batten down the hatches because oil and gas prices are going much higher, and no one can predict how the situation in Ukraine is going to spin out. And he says that the worst is yet to come. And so here's two super well-connected organizations. I mean, two of the world's biggest banks, and they can see what's happening with payments from all these different companies and all these different sectors of the economy, and they're completely at loggerheads. And so I could give you my opinion for what might happen over the next 90 days, but it really wouldn't be worth anything because I don't know. And quite frankly, neither does JP Morgan or Citicorp or Goldman Sachs. And they all go on these shows and they make their predictions, and if they're right, they're invited back and remind everybody that you said 3 months ago the market was going to take off, and it sure enough has taken off. Tell us what you see now. But if you flipped a coin and I said heads and it came up heads, it doesn't mean I'm a great coin flipper. It just means that I got lucky. So I wish I could say what's going to happen in the next 3 months. I don't know. No one is more surprised than me as to how the market action plays out. To me, it's always fascinating. To me, the financial markets are the world's ultimate Rubik's Cube because everything that's happening in the world, think about this, all the government legislation, all the business innovation, all the scientific advances and medical advances, commodity prices, currency exchange rates, geopolitical situations like Ukraine, all these, if a ship gets stuck in the Suez Canal, that shows up in the stock market. All these various things are happening. It's a wildly complicated, hugely complex world. And everybody, as I said, you've got these genius level people all looking at the situation and placing their bets. And I wish I could say that I'm smarter than those people and here's what the market's going to do in the next 3 months, but I don't know. And I started off talking about Warren Buffett and Peter Lynch and John Templeton stating that they don't know what the economy is going to do and the market's going to do. They only know how to identify companies that are selling for less than what they're worth. And that's what I think people should be doing now, is not asking themselves what's going to happen the next quarter, because it's kind of like asking, do you think it'll be cloudy 2 weeks from Thursday? Well, who knows? I mean, even the best meteorologist in the world doesn't know if it's going to be cloudy or sunny. So what you should be doing, instead of trying to outguess the market, and maybe being right, maybe being wrong, is to, again, look at individual companies. Are they growing the business? Are they increasing market share? Can they protect their margins? And is the stock cheap relative to their prospective earnings? And if so, take at least a half position. If the market goes lower in the next 90 days, pick up the other half of your position. If the market turns around and goes up, at least you got your foot in the door and you got some of the stock. So it's all about sort of knowing what you can't know and hedging your bets and just trying to make the best of what's always an uncertain outlook. Good times or bad, the outlook is always uncertain.
Alex, I appreciate your candor, because there's a lot of people in our industry that would try to tell you, like if I asked that same question, they try to tell me what was going to happen in September. But you didn't do that, which is good.
Well, but let me tell you, Edison, I listen to the bullish commentators and I listen to the bearish commentators, and I could sit here right now and give you a bullish forecast, and I could point to every positive that's out there, and there are positive, you don't read them about them much in the media, and I could paint this glorious picture for the next 90 days, and then I could switch and I could give you all the terrible things that might possibly happen and why it's going to go lower. And in my head, I'm always thinking like, yeah, this can happen, that can happen, because it's always a mixed bag.
Right. And the thing is, if you gave me both, you'd be right.
Yeah, one of them be right. And I'll tell you 90 days from now which one it was.
Yeah. All right, cool. I will catch up with you later. Thanks for joining me on the Wiggin sessions.